Hi guys, good evening and thank you for tuning in to Markets Weekly on Money Control. I'm Karunya Rao and once again we've seen an action-packed week. In fact, this has been a second straight week of losses for the Indian markets. It's been the biggest weekly loss since May 2020. In fact, all the sectoral indices recorded losses this week. Metals, PSUs, IT sector, they were the worst casualties of the ongoing selling that we're witnessing in the markets. Joining me today is a very special guest, Mr. Ajay Tyagi from UTI AMC. Ajay, thank you so much for taking time out and chatting with us today. What has been your assessment of the market? Because I'm sure you have seen various similar periods in the past, whether it has been the 2008 crisis or even before that. What is different this time around, and how should investors look at it?
Yeah, first of all, thanks for having me here. You see, while every drawdown, every market correction is different in its own way, but I think the behavior of investors and eventually how markets correct is pretty much the same. So yes, the 2000 to 2002 crisis was different from the 2008 to 2009 crisis, and of course, both of them were different from the pandemic-related drawdown that we saw in 2020. And this time, the real reason for panic amongst investors is the ever-increasing inflation and to control that inflation, the increase in interest rates being affected by the central bank. Now, this has two consequences. One, of course, is the fact that as cost of money increases, the value of different assets is only expected to come down. That's the theoretical part of it. And the more practical part of it is that increase in interest rates beyond a point does kill demand, does kill consumption spend, and therefore leads the economy down the path of recession. So I think this time the set of reasons are slightly different from what they were in the previous crisis, but the investors really don't like to see losses, and therefore they in some sense uh, accentuate the impact of these economic variables in the stock markets by getting into a vicious circle of selling, which leads the markets to come down even further. And I think to that extent, this drawdown or this bear market is pretty much similar to all others in the past.
The one thing that we're noticing this time is that the markets are facing a selling pressure on all rises. There has been no way that the market was able to sustain that momentum which it was trying to sort of break out of. Talk to us about what is the reason behind that.
No, I think here again, I would say this is typical investor behavior. I think in the very early stages of market correction, you see investors still holding fort, being bold enough and saying that, look, this is a great buying opportunity. Markets are down 5-10%. I'll increase my allocation to equities or I'll invest more. Then comes a point when markets are down more than 15% or 20% like they are right now. And at that stage, investors really start to panic. In the first stage of this panic, they would still not capitulate and pull out. They may just stop incremental investments. And as the markets progress further in their journey of this drawdown, will come a stage when investors start to move out. Basically, they just press the exit button. They kind of pull money out and invest into whatever they feel are the safer options. So I think we are somewhere in the middle of this journey. We are still seeing flows coming in. We still aren't seeing investors panicking, not yet in India. Of course, to some extent, the data coming in from the US is suggesting that investors have become net sellers in their own domestic markets in various ETFs and mutual funds. Not yet in India, but as markets progress, if we don't see inflation stabilizing and therefore the comfort amongst investors that central banks indeed will stop their journey of interest rate increases, if that signal doesn't come in, I would say that investors will continue to panic.
Okay, all right. So, what is it that you're telling your clients and various investors who are reaching out to you, what should be the strategy at these levels? And given the way the macros are playing out and there's so much of uncertainty, what should be, you know, what should be the mantra right now?
So I think first of all, as long-term investors, we have to appreciate the fact that uncertainty is always the friend of an investor who's trying to invest from a 5-year, 7-year, or 10-year perspective. While this uncertainty is very bad for investors who are looking for a quick buck or for traders, but this uncertainty, and history proves it, is really the friend of the long-term investor. And I define a long-term investor who at least has a 5-year horizon, if not more. So our message to the investors is very simple. We are looking at this equation from a fundamental perspective, number one. And therefore, what we are picking up is that valuations which had reached a peak, and I would say a multi-decade peak, or at least a 2-decade peak, if not a multi-decade peak, at about 25 times 1 year forward back in October of 2021, have already corrected and come down to about approximately 19 times. Now this fall in valuations of approximately 25% is a combination of price correction and also the fact that there has been earnings accumulation in the last 9 months. So earnings have moved up and prices have come down, and as a combination, therefore, price earnings multiple is down 25%, now about just 10 to 15% higher than its long-term averages. And we love to actually draw long-term averages over 20 years and more, and rather than just about 10 years or 5 years. And even over a longer period, like I said, 20 years, which does include 2 full cycles, what we realize is that we're just about 10 to 15% higher than the mean, which is giving us this comfort that these indeed are not frothy levels to actually make incremental investments. It certainly doesn't mean that the downside is going to be just about 10 to 15%. Markets do, in a state of panic, go below the mean or the median, but if they indeed do that this time as well, it certainly would be an opportunity to improve your longer term averages in terms of the returns that you make out of investment into equity. So our short message is continue with your SIPs. The more the market falls, the higher the comfort in terms of future returns. If markets were to crash another 10 to 15% from here, that's really a great time for you to make lump sum investments or to increase allocation towards equity by pulling money out of other asset classes and putting into equity. So that's the short message.
We have spoken to a lot of experts, a lot of market watchers, and they think that there is a chance that India could witness a bear market in the latter half of FY23. Is that something that you concur with, or do you believe otherwise?
See, I'll be honest with you. I think none of us know what's going to happen in the markets over a 3 month or a 6 month period. I mean, yeah, we can all draw narratives and we can all tell stories. But quite honestly, my 22 years in this business and my organization's 6 decade into this business just teaches us that you just can't predict, where the markets are moving in the short run. So we really don't, try to figure out what's the direction of the market in the short run. But like I told you, looking at data, we always try to understand where are we in the journey right now. Where are we in terms of the correction which started to happen sometime towards the later part of last year? We are already, let's say, 8 or 9 months into it. How far can the bottom be? So I think from that perspective, like I said, the journey seems to be almost half done right now. Uh, we can correct some more, but you see, the beauty about market corrections and multiple corrections is that they can either happen by way of a very swift correction in prices, or they can equally happen by way of earnings accumulation. So when I say that we will get much more confident if long-term multiples were to come to their average levels of around 15 or 15 and a half times 1 year forward. It can either happen if prices correct 10, 15% from here, or if prices just drift sideways, but earnings accumulation over the next 6 to 9 months pulls down this number. Now, which one would it be, or would it be a combination of these two? Is something, quite frankly, it's very, very hard to predict, and to some extent not very worthwhile as well.
Okay, all right. But are there any sectors at all that look resilient to you right now in the face of all these headwinds? Anything that you see value in?
No, absolutely. This is the conversation which we keep doing. Morning to evening in terms of which are the sectors, and within sectors, which are those companies which are looking extremely attractive. And of course, there are at a more, I would say, a higher level. I would say there are a few sectors which certainly are looking very attractive, and I would say IT and technology is certainly one of them. There seems to be some kind of a I would say, spurious correlation that investors have been trying to draw between NASDAQ and tech in the US and IT services here in India. But I would say, this is absolutely incorrect for the simple reason that the tech companies which are seeing a huge correction, and which are being bruised and battered in the markets in the US are typically companies, except for a couple of dozen, are typically companies which are profit tomorrow companies, are typically companies which are either into losses or have wafer thin margins when it comes to profits. And they indeed are not making strong cash flows. If you compare them to, let's say, the IT services company here in India, I would say this sector is basically the home to some of the strongest companies in India, Inc., in terms of both margins, cash flows, balance sheet strength, and also corporate governance, by the way. So, most of these companies in India, the IT services companies, that is, have seen a huge correction. Like I said, some perverse correlation is being drawn between their price behavior and Nasdaq. I don't think that is based in fundamentals, and therefore, we are excited about this sector and some of the companies which really have a winning business model in this sector. Equally true for financial services. This is also one sector which really has one of the best managed businesses in corporate India, and we've seen how the banking sector has performed over the last couple of years. Although fundamentally, the good news is that balance sheets have been cleaned up. The NPA cycle is behind us. All the banks in the private sector, at least, are sitting at very, very high tier one capital, and therefore they're all ready for participating in the credit cycle as and when it emerges. So I think banking, IT, and then selectively we are seeing opportunities across the board as well. So that's some good news for fundamental investors like us, because we've seen opportunities emerge after a reasonable amount of correction that has already happened in the last 6 months.
Okay. All right. What about PSUs? Because they have really, taken it on the chin in the recent market correction. Do you believe that this is a downtrend that's going to sustain over the near term, at least, if not the long term?
Well, this is a good one. There is always this tussle between what's your view over the next 6 to 12 months basis valuations, and what's your view over the next 3 to 5 years basis the ability of the business to create economic value. And at UTI, we basically always try to focus on the latter, in terms of, first of all, assuring ourselves about what indeed are the prospects of the business in the long run. Is the business being run by some of the best and the smartest people who are going to be around running this business for the next decade? And is the business going to create economic value or not? Now, if you view most PSUs from this perspective, they don't check these boxes, unfortunately. They're always cheap, and many investors have been successful in terms of buying them at cheap valuations and exiting them when the valuations are not so cheap. But you see, on the whole, if I were to make a broad brush statement, I would say PSUs across different sectors do face challenges on the 3 or 4 factors that I mentioned to you. But yes, selectively, there could always be cases in different sectors and industries. But if you're talking about PSU as one full, theme or camp, I would say from a longer term perspective, we don't find too many opportunities in that camp.
Any other total avoids that you guys have right now?
No, actually, total avoid is an extremely harsh statement to make. I don't think in the context of stock markets they can ever be something which is a total avoid. So we always keep our eyes and ears open in terms of how opportunities are coming up, because what may look like something which is not a great investment right now may actually look at a may actually emerge as a very attractive investment if it corrects by 20-25%. And these days, like you just mentioned in your opening comments, a 20% correction in stocks is not something which take months. It just takes a couple of weeks. So yeah, I mean, I think as a theme, I would say the total avoid for us would be businesses which basically are having this constant need of liquidity to run themselves. So any business which organically and inherently is not able to actually generate enough cash flows is the one which will actually be at the wrong end in this particular economic scenario. So these businesses which have high cash burns, and now that we know that liquidity is going to be sucked out of the market and the cost of liquidity itself is going to go up, such kind of businesses will indeed suffer a lot, and therefore we would want to avoid them at this stage.
If one were to start investing today, firstly, I think retail investors would be very wary of what's going on, because this is very different from the market correction we saw during the start of the pandemic, because it did fall a fair bit, but then when it started recovering, the recovery has been very resilient and very sustained fashion. But let's talk about, if somebody wants to enter the markets right now, what would be your advice to them? Firstly, should they start investing right now? And if yes, how should they structure their portfolio?
No, Karunya, I would just say that there can never be a time where we would come out and tell our investors this is not a great time, don't invest. Because I just mentioned that we don't know how markets would behave. So as you rightly mentioned, in March of 2020 and also in April of 2020, nobody could have imagined the kind of V-shaped recovery that the stock markets witnessed in the following months. And if you would have told investors, look, the world has gotten into a stage which we have never witnessed before. We have seen different kind of crises, but a crisis on account of a pandemic which locks down and shuts down the entire world has never been seen before, and therefore we don't know how businesses and economies would react. Then just imagine, the loss of opportunities for those investors. So we never say that, look, don't invest. What we always say is invest in a disciplined manner at regular intervals, and the best way to do that is a systematic investment plan. It could be a monthly or a quarterly or a 6 monthly kind of an investment. And then in addition to that, we keep guiding investors, looking at the valuation and telling them that, look, if valuations have corrected below the long term mean or median, then this is a time when you can accelerate your investment or make some lump sum investments. That's the only bit of hand holding that we try to do. And equally on the other side, when valuations are bursting the charts, moving up north and not giving us this comfort, we do tell investors that, look, don't be brave right now. Try and exercise caution. Don't get onto the small and mid cap part of the markets, and also don't make lump sum investments at this stage at all. So yeah, I mean, that's the only word of advice we give them, in addition to our perennial word of advice that invest into markets at frequent intervals.
All right. On that note, Ajay, thank you so much for sharing your insights and your wisdom with us and our viewers, who many of whom are retail investors. I'm sure they'll have a lot to take back from today's conversation. Thank you so much for taking time out. And guys, thank you so much for tuning in. We'll see you next Friday. Have a great weekend.
Thank you.